Hello and welcome to another episode of The Long and Short of It. I'm Patrick Seresna.
And I'm Nick Galarnik.
Nick, buddy, what a crazy 2 weeks. Like literally, we had a wipeout to the downside on the markets, and one monstrous up day on Wednesday. That was the third largest up day since 1990. So you have to go back to before you were born. No, just kidding. But
Yeah.
like you have to, but
Yeah.
you have to go back quite far to find a day of that, and that's normal for bear market rallies, because when markets crash, from a reflexive perspective, the magnitude of the drop is directly related to then subsequently the magnitude of the rise. Like, because
hmm
it's like I always describe it like a bungee cord.
Yeah.
And like when you jump off a bridge, if that bungee cord stretches too much, then a snap the other way is often as violent as the drop on the way down.
Yeah.
And so we got this rally, and we find ourselves obviously in this crazy situation where the tariffs drove all of this emotional stuff. So we're going to talk quite a bit about tariffs here, just what impact it has on the markets, and what it means, and where the next trade is. Everyone stick around. We're going to talk about how to trade the next tariff move. But what was crazy about this was it was a sell everything America, where
Yeah.
basically we had bonds, the US dollar,
Dollar. Yeah.
and the stocks all declining at the same time, which is, from an intermarket perspective, incredibly rare.
It never happens, basically. Yeah.
Very rare for it to happen. And it really shows that some sort of different paradigm shift is happening, and the flows is changing. So what's your take on all of this, buddy?
Well, I mean, I have a few different thoughts overall, but like what I've been noticing is that I like to follow patterns. And in Trump's first term, there were certain patterns involving the trade war with China. In this term already, we've kind of seen a small pattern emerge, which was last Monday when we had that, that 5 minute, 10% rally on everything essentially, where news broke that there's a 90-day pause on tariffs. Um, and then it was subsequently shown that it was false, and the market came back down again. That, to me, I said to my small group of people that I trade with, I said, this to me seems like a dry run to test to see how high the market would move if this news actually broke. And so I said, be prepared for this to happen again. I was actually long IWM calls when that happened. So it was an
Oh, great.
awesome trade. Like I got in and out almost at the perfect time. It was a great trade. I sold off at the pop and I said, you know what, I'm done for the day, and that's it. And then it came back down again. And I said, okay, cool. But
No, it's
so
awesome. Congrats.
the point here, thank you. The point here is that identifying trends. So then what happened was 2 days later, the exact same thing happened. But remember, on Monday, the news broke at about 10:30 in the morning, roughly. So earlier on in the day, when options are still very expensive on 0-day options. So fast forward to Wednesday, the same thing happened after the Treasury auction at 1 p.m., but it happened at 1:30 on Wednesday. The reason why this is important is because option prices were so much cheaper for 0 days, and we saw a lot of flow coming in on 0 days on Qs, SPY, IWM, SPX, XSP. And these were orders in the magnitude of over $1 million. So I've actually, like, since then set up a small algorithm, or like an alert for myself using Python to look for trades that happen 0 day that are in excess of $1 million that expire same day, but only afternoon, because that tells me that someone's betting heavily on an event that's improbable, especially when they're about 3 standard deviations out of the money, meaning that the implied
Yeah.
range for the day is not implying that those options should hit. Therefore, why would someone place a bet of, let's say, for example, $7.6 million, as they did on last Wednesday, on
You
a
know what?
crazy move happening, right?
You're gonna have
So
to sell that algorithm to the Security Exchange Commission, because they're gonna want to have a conversation with a number of these people that are buying 3 standard deviation options in that size. But
yeah,
like that's always interesting to see those kind of flows, and what drives it. Like I think that a lot of our listeners love the fact that we're kind of going through how things played out. But I feel that the one thing that will really give value to our listeners is talking about what's going to happen moving forward.
Yeah,
And so now we're in a situation where, okay, you're looking for these kind of news announcements in there.
yeah.
What are you focused on in the next week or two in terms of potential market movers that we can all put trades on and profit from?
Yeah, so for me, I'm looking at semiconductors primarily because on Friday, as you recall, after hours, of course, when it wasn't tradable at all, news broke that they were going to, eliminate tariffs on semiconductors and computers and smartphones, right? And so everyone
Hmm.
thought over the weekend, oh my God, semis are going to shoot up like crazy. And I actually bought some SOXL calls last week that expired this Thursday. And on yesterday they opened up not as much as I thought they would, but they were up about 40%. So
Right.
I cashed out right at open. I said, you know what, I'm not going to risk this because again, they walked back what they were saying on Friday again. So again, the pattern is emerging already that, we're seeing these news events break, testing to see what the reaction will be. Then the actual event happens. And that's when, whoever's trading in the background is going to make a lot of money, obviously, off this,
Yeah.
information that they clairvoyantly have on a 0-day option, for example, or semi expiration, right? So, semiconductors, the reason why I'm looking at SOXL versus SMH, for example, right? Because that's a question that I get
Well, let's
off.
let's actually start off and look at the chart.
Yeah,
I feel so. Let's start with the SMH because I want to just talk semiconductors in general. Obviously, the largest holding is Nvidia in this, and Nvidia. Just quickly looking at this chart, had obviously its bull run in 2024, and since then, after hitting a peak just above $150, has gone through a correction of about 43%, down $67 during this correction. And we've been bouncing since, and we're bouncing back to the 50-day moving average on that. So it's important to know the biggest component. But when we go to the SMH, the semiconductors had a pretty interesting chart setup in it that when you go back to 2024 into 2025, the market failed to make higher highs at the start of the year when everything else was still hot. So this was already a very heavy market. Nvidia wasn't participating with the Mag Sevens. You basically had stocks like Intel finding a very challenging period. Qualcomm was running into a lot of problems, at least technically that was. And so there, AMD's been in an awful downtrend. So semis were like all stuck in the mud and grinding. And when that whole sell off began, we basically saw a peak to trough drop of about 36% in this. And as well, we're now getting this market bounce. We're getting this market bounce. It's interesting is that the 50-day moving average is around 220, which actually is very close to where a 50% retracement level of the whole move is. So this relief rally has come in. And like you were suggesting, um, we're now getting some tariff announcements on the semis. And this makes it a really interesting moment because you're not neither buying at an extremely oversold condition, nor are you selling at an extremely overbought condition. We have this kind of market that has kind of neutralized. It was
yeah,
at extreme high, extreme low, and we've now kind of bounced into this midpoint no man's land. Generally, volatility has been contracting in this entire space, and we have this catalyst, like you're saying, that could potentially be a market mover.
yeah,
And so we know that this is going to some sort of news is coming. What we don't know is what it means. And what I want to start off by just looking at the implied volatility here of the semiconductor SMH implieds. Obviously, we're talking about higher implieds on the triple exposure that you want to talk about.
of course, yeah,
But what's interesting is that this April expiry, right? And this is the April 17th expiry. We're at 74% implied.
yeah,
Next week, we're down to about a
57,
57%
yeah,
implied. And so we're at a situation where volatility is still elevated, but it's already off of some of those most extreme levels on the upside. Yet market volatility can be there. So what is your trade? What are you thinking here, buddy?
So, like with SMH, obviously, my thinking is straddle, right? Straddle is buying a call, buying a put at the money, and hoping you get an outsized move that exceeds the overall cost of the entire straddle. So, the reason why I'm not looking at SMH right now, although it could very well work with SMH as well, is because the pricing of the straddle is expensive, right? It's about $17 per at the money call at the 200 strike for next Friday, and so that gives you two break evens, right? Like 200 plus 17, so 217 on the upside, and then downside would be 200 minus 17, which is 183. So you need to move other pretty much
Yeah.
to the lows on SMH to make money, or you need a pop above like the recent, like pretty much above the 50-day moving average roughly, and that
Right.
will make you profit, right?
So
Um,
basically here, what I'm doing here is I'll just draw on your box. This box right here more or less represents, that if the price stays within that box, you will hold all the way to maturity, because
yeah,
obviously there's time value even in the days before.
yeah,
But if you held to maturity and it's inside this range, there's a good chance you're not going to make money.
yeah,
And now, what you're looking for, therefore, is a move on this either higher or lower based on some sort of a news reaction. So I just want
yes,
to clarify also for all of those that are listening that we are talking about a market move that happens by April 25th.
yeah,
So we're talking about that idea that there's going to be an announcement, whether over the Easter weekend or in the first few days of next week,
yeah.
that suddenly triggers a market volatility event that allows this to play out. So now you're though looking at this on the triple exposure SOXL. So
That's
why don't
right.
you
Yeah.
talk us through this?
So my rationale here is that, if you're going to go for leverage, go for the extreme leverage in the case of a thesis where you think you're going to get a market moving event. And also, the price of the options is much cheaper overall, albeit percentage wise, it's greater because you're spending about, for a straddle here, it's about $2 and change to straddle the SOXL for next Friday as well. And so in this case, you need to move, below 8 essentially. The lows, keep in mind, recently were 722 last week. What we saw last week actually was pretty interesting because we saw the lows hit 722, and then we saw it push out all the way up over 13. So that's how fast, like, this thing can double very quickly because it's so leveraged, right?
Yeah.
If we get a 10% move in semis, this moves 30%. If we get a 20% move in semis, this moves 60%, right? So you're paying less premium overall, so less dollar risk is a key benefit, obviously. Um, but obviously, it could just bleed out as well. And if we get no news by next Friday, basically, you might say, okay, by like next Wednesday, you might cut the trade and take your loss. And as I'm talking right now, the straddle for this coming Thursday, keep in mind Friday's a holiday, so 3 days away, the current straddles are about $1.60. So really, you'd only lose about, let's say, like, if you pay, let's say at the midpoint, like 240, 250 for the overall straddle right now, which is on the higher end, you'd only lose about 90 cents or so, even if you're to hold to next Wednesday and cut your position, maybe even roll it forward another week, perhaps try and capture that news event.
Hmm.
Because once Trump announces the tariffs on semis, either they're going to be very favorable, in which case we're going to see a take, NVIDIA, AMD, Texas Instruments, like, Qualcomm, you name it, take off, and SMH will take off as well as SOXL, or you're going to see it be much more harsh than we expect, perhaps. In which case, you're going to see them all plummet back down again to the lows. In this case, you could see SOXL trading at like $6, for example, right? In which case, you almost
Yeah.
double your money on SOXL. So for the same thing to happen on SMH to double your money, it has to move 34 points roughly, right? So to 234 or down to 166 pretty much. So I'm just talking pure asymmetry of risk here. Like what I've been doing in this market, because it's hard to really stay long heavily, is I've been taking small stabs in very small positions, like 0.5% allocation of my portfolio, for example, on a 1 week out trade If I lose 0.25%, perhaps half the position. But if I win, I make 2, 3, 4, 5% return on an outsized move. So pure asymmetry of risk, barbell investing 101 essentially, right? And I'm just focusing on that because right now it's hard to say long anything in great quantities in your portfolio because again, we can get the most random news pops out and the market falls 10% again in a week, right? Do you want to experience
Yeah.
that? No, I don't see, like, once I see resolution overall across like the tariffs, for example, if they come to trade deals with, with China and Japan and everyone else, and we see more stability, that's when I see like, a good chance of us going higher, and for a longer period of time. But until that happens, this market's kind of uninvestable right now.
You know, the um, the complete speculator in me is just thought about when you were explaining this, how to play this as a calendar trade, which is that if your confidence level that this is an announcement next week or over the weekend, and not an announcement this week before Thursday, uh, why not go long the Jan 2000 January, sorry, the not Jan, the
April.
April 25th for
Yeah.
let's say 240, and go short the April 17s for a buck 60, buck 70, and literally you're hedged out. There's obviously risk, but
Yeah.
from a time perspective, but if you're right, then you just ended up cashing in the income
Yeah.
off of the 1 week, and then you're speculating into the next. It would be a really interesting way to. I almost got to try this anyway. It's a great idea. The
It is. It is.
what I want to talk about though is, first of all, generally for me, this is just me. I generally avoid double and triple exposure ETFs, largely because of tracking error issues
Yeah.
and all sorts of other management of the ETFs, which
I agree.
often creates a second variable of risk. Where the ETF does not behave the way you expected it to,
Yeah.
versus using something like the SMH. And so you're absolutely right from a dollar perspective. You obviously, on a $200 unit, are going to outlay more for the straddle.
Yeah.
But ultimately, you're going to be able to get a similar exposure and similar type return if you size them on a vol adjusted basis, right? And
Absolutely. Yeah.
and so really, it's up to our listeners as to what they want to do. I do like the idea that the semis can be volatile. It's certainly something I think is at least allows you to thematically play the story. The one thing I don't think is going away is market volatility,
No.
and the fact that the S&P is already 50% retraced. The odds that we're going to have a fake out both to the upside and to the downside here off this pivot is very likely. And if we have any noise making event where the market goes and rips any percentage 1 day move, you're going to have vol spike. You're going to get a Vega kick at the
Yeah.
same time as you're going to be long Vega, long the vol on the straddle. And if the price move is good enough, you could probably even walk away before the announcement. You can,
Absolutely. Yeah.
like you might find yourself in a situation where it's just a no brainer to grab at that premium on there. The other thought that I had here, which is clearly showing that we're in a period where the front week expiration is commanding a very large implied vol premium.
Huge premium. Yeah.
And so there's almost a simple weekend carry in that even if you open this thing for, let's say, $2.50, and where I'm rounding, right?
Mhm.
Well, odds are on Monday, if the announcement didn't happen yet, this thing will still be worth a buck 70 if the price didn't even move, buck 80. Like, you
Yeah.
have a very good chance that you carrying for almost an entire week might end up only costing you 20-30% of the straddle.
Yeah.
And even then, if you don't like your situation, you can carve out of the trade and still be able to recover a very good chunk of your capital if it's not happening in that window. And so the idea of carrying it for a full loss into expiration seems like a foolish thing to do. Almost, you can almost make a bet on this trade and probably be risking no more than 50% of the capital in the trade,
Yeah.
even if you're holding it into the middle of next week.
Yeah, I mean, like the cool thing about options is that there's really an infinite permutation of the ways you can trade a given thesis, right? Like
Yeah,
there are more permutations in a given trade strategy than there are in moves in Go, for example, like the famous like
yeah,
a game from Asia, right?
yeah,
There are more permutations than there are atoms in the universe overall, right?
right.
So, like when you think about how to play this, given what you just said about the front week being very expensive, you could also, for example, sell this Thursday straddle. Keep in mind Friday's a holiday, and then buy next Friday's straddle as well, incurring a small debit amount. Now, if we get no news by Thursday, the front week expires worthless. You capture all that premium, and then you have next week exposure for a very, very small outlay, right?
Yeah,
And if we get news this week, big deal. Your maximum loss is whatever you spent overall on your credit. I mean, on your debit of the
yeah,
position, and that's a risk you take, right? I mean, you could do that, or you could do like a reverse iron butterfly, which is more complex. But the point is that when you have a thesis, you can express it in any number of ways. It's just a matter of like what's your desired risk and what's your desired reward.
yeah,
And you have to
yeah,
approach every single move you make from that perspective. Because if you want outsized reward, usually need to take outsized risk. If you want, a more certain reward, you got to take less risk perhaps, but you're going to have a much lower upside perhaps, right? Like
right.
if using spreads in this example, like, let's say you did like long the 200 straddle and then short 210 call, short 190 put, for example, right? Then you're bracketing your maximum upside, but your outlay is much less, and the probability of us moving above 210 or below 190 is very very high. So the probability of winning is much higher, but the overall payoff is much lower. Therefore, the expected value is also much
Yeah.
lower as well.
So let's just take a moment to wrap this up as a conclusion here, and just break this down a little bit simpler. So just to remind everyone that's newer to options, what is it that we try to accomplish with a straddle? A straddle, in its purest definition, is you buy both a call and a put option. That you're betting that you don't give a shit which direction the stock goes, long as it goes in a big way. You're paying a premium, and you're basically buying two directions, both on the upside and the downside. So you're doubling the cost of your trade, but you're almost agnostic because long as it moves one of the directions in a big way, it's going to pay off.
Yeah,
And more often than not, this is not an easy trade. But when you are in a market environment like we're in, with catalysts the way we do have, often these straddles may be underpricing the volatility that the market is capable of doing, especially over any short window of time. And so, what Nick was really trying to describe here was that semiconductors could actually be big movers here, and that these options, while they're priced pretty expensive, like I mean, we're talking over 100 implieds on those 3x leverage there, but this is a stock that literally can move almost 100% in a week like it did.
yeah,
And so we're talking about something that's priced at 100 vol because it really is a mover.
yeah.
And so Nick, good luck, buddy. Let's see how this trade works out, bud.
Thank you very much.
Any last thing you want to comment on? Or are we good?
No, I mean, I just say again, like I always say every week, just manage your risk and make sure that you really understand what you're doing. I'm, what I've observed the last week or so is I've seen a few people take trades that they don't understand, like, an iron condor, for example. And then they ask, how do I get out of this strategy? And it's, if you don't understand the strategy, just don't do it. Like maybe paper trade it, test it out, see how it works out for you. Because again, there will always be more trades, trying to be a hero and, use something that you read about on, in a blog for the first time ever in live trading during a volatile market, it's very dangerous, and your capital should be protected first and foremost. So manage your risk.
So my I just want to add to that point there. In my early trading, I always made the conclusion that by doing something more sophisticated and more complex, I somehow thought I was smarter and better and was able to get a potentially better trade on. And what I've found is actually the more complicated you make the trade, sometimes the smaller you end up doing it, and the
Yeah.
more variables are introduced that don't that surprise you with the way that it behaved. Sometimes the best is to trade with high conviction on a trade that is executed a little bit simpler,
Keep it
and one
simple.
that you can that you can execute with high confidence and get real results. Because a confused mind says no is the famous thing. And when you try to do something too complicated, you end up not taking the position you should have taken in the first place. And so
Yeah.
sometimes, like, listen, we talk all this complex shit on options because we want to be experts and we want to understand, but just because we know it doesn't mean it's always the best way to execute it by making it complicated. Anyway, that's my 2 cents. Listen,
Absolutely.
everyone, thanks for joining us. Nick, it's a pleasure as always. Looking forward to the next episode with you, buddy.
Likewise, Patty.
Cheers,
All right,
everyone.
guys. Bye, guys.